Equity and Credit APAC Chief Investment Officer at UBS joins us. Good morning, Hartmut. Thank you very much for dropping into our studio. What's the sense? You're looking at the Dow futures, you're looking at the Nikkei taking some courage from it. Can there be an exhaustion of selling at least?
Yeah, it's interesting, isn't it? The culprit oftentimes is made out to be China, but I think it also has a lot to do with the fact that we're moving closer and closer also to the first Fed rate hike after 2006. So there hasn't been a Fed rate hike in a long time. And it's actually, historically, it's quite normal. It's not unusual that markets just get nervous around that. And I would more assign it to a nervousness rather than to the fundamentals. Look, if I aggregate GDP growth, and you can argue that it's maybe not fantastic or not stellar this year, but we're still having global GDP growth this year. Likewise, we do have global earnings growth on the corporate side. So to me, it would be really questionable whether stock markets should really close the year flat. I don't think they should. I think they should, given the circumstances, nonetheless close the year up.
Okay, stock market should close the year up. That's interesting. Hartmut, hi, good morning from India. Are we heading towards some sort of a global meltdown, or do you think that fear is overstated?
Yeah, that is very curious, and I understand that people looked at the ISM yesterday, and that was, but we can really not hop just from data point to data point. I could easily counter that last week, somewhat related, also business spending ultimately, durable goods orders surprised last week. So it isn't really that conclusive. What we do know is the US has a very, very strong labor market. I think we'll see also more evidence of it on Friday again. So the only piece missing in the equation is inflation, but activity data very strong. Europe, and not many people talk about it. We just had Italy, for example, yesterday, which was arguably the laggard so far. Even their GDP numbers get revised up. Even their unemployment gets revised down. So Eurozone actually very clearly in recovery mode here. And then lastly, that leaves us with China, and all the pundits are. Every year, basically, there are a few weeks when everybody, or some people anyway, predict the collapse of China. It's become normal now. Look, China, we know that, and it's evident it is slowing down, and that is just a fact. The next year, for example, we think on the GDP side, you only see a 6% handle, not a 7 anymore. We have to get used to that, but it doesn't mean it's going to be a collapse. Also, if I dissect the data a bit more in detail, yes, the manufacturing side is weak indeed. But there are other areas. Property seems to be turning around. Services, which becomes an increasingly important part or growth driver really for China, almost half if you count everything in now, is doing better. Positive lead indicators. So the Chinese data is a bit mixed. Arguably, not everything strong, but couldn't argue that everything is weak. If I look at the fundamentals, I do not see that meltdown that maybe some in the markets are looking to price in right now.
No, I take your point on that, but there is a bearish mood, a selling mood in the air. Will that, that's the tough question really. Does that get exhausted anytime soon, say today, tomorrow? Will the market find its feet? And separately, do you think, what would you buy in this dip? Are you already a buyer?
Look, I think we have to admit that it's very tough to time the exact bottom of the market. For me, it's important that we do not see, especially in the regions that I just mentioned, that we see a massive deterioration that makes this pullback look as if it were justified. Don't expect it. So we think, give it a couple of days maybe, or even a week or two, but ultimately this nervousness will pass. And I wouldn't also be surprised if it passes, especially if and when finally the Fed does the first step on the rate side. I think that could actually add to stability in the market.
Okay. And how do you approach a market? Sure. How do you approach a market like India now?
Yeah, India, maybe I should add that quickly, again, fully finished with my answer. So spots we like in the investment world are certainly those where the central banks are still very, very loose or very supportive, if you will, and where we do see even double-digit earnings growth. And these places still exist. The Eurozone is one of them, and the other one would be Japan. We also do like high-yield bonds in particular as to round out portfolios. And one message I also wanted to give not too long ago, on a more strategic, more long-term capital allocation, we have also replaced a part of the government bond allocation in favor of hedge funds. We think, given that bonds do not promise, especially government bonds, do not promise big returns, hedge funds could be a good, partially at least, substitute for it. And now, how do we see India? I was actually quite encouraged, even though the 7% numbers seem to be a bit lower than what consensus expected. But I think, by any means, a 7% number these days is a very strong number nonetheless. But also looking more into the details, I see that one of the things that I have been waiting for, and namely the pickup in the investment component, that's very encouraging. But also some of the other data around GDP or around economic activity, if I look at the tax intake on the government side, also how much they now allocate to the states, these are high double-digit, very solid double-digit growth numbers that spell more investment spending, in my view, to come here. So India probably is one of the very few economies where you can plausibly argue that it's not only growing relatively fast right now, but it can actually gradually even accelerate. So I think that certainly valuation premium that India undoubtedly has is there to stay. It remains one of our preferred markets, both within Asia as well as in EM.
All right, Hartmut, Issel, it was a pleasure speaking with you. Thank you very much for dropping by into our studios this morning. All right, in the many pockets of buying, we are not very high, but at least there is a positive attitude towards India. Let's see. It's